one of the problems that I've personally had, not just with this, also with a lot of these social media influencers, is when if you need to set the expectations right, when people are starting investing in the markets, people shouldn't come to the stock markets thinking they will double the money every year, or they'll make 10% a month or whatever, right? Because it's almost impossible to make that kind of return. Of course, you can have short periods of time where you make it, but otherwise it's highly unlikely that you can make like a lot of money very quickly in the markets. Because when people come with the wrong expectations, they will get disappointed. If they get disappointed, they will never come back, which is not really good for anyone. I mean, it's not good for the brokers, it's not good for the influencers, it's not good for the exchanges and the entire in the country itself. So one of the things that we've constantly tried is to figure ways in which we can set the expectations right with a customer when he's onboarding. The most important thing is the expectation. Now, the second thing is, of course, the plan, right? Which is, once you start investing, it's not easy to make money investing in the markets, right? I mean, there's a lot of skill required, right? And but in a bull market, it seems very easy, right? As in that's really the problem. So we're also trying to constantly educate people that what is the right way to approach investing and trading, which is don't be concentrated in one or two stocks, or understand that there is a disposition bias, which gets you to sell your winners, buy more of your losers, while you should be exactly doing the opposite of that when you're managing money, which is hold on to your winners and sell your losers. Assuming I have two stocks, I bought both at 100 rupees, stock A and stock B. Now stock A went to 130 rupees and stock B went to 70 rupees, right? What are bias? I mean, all of us are physiologically, we have some biases towards, when it comes to money, right? When a stock becomes 130 and another stock becomes 70 and you hold both of it, instinctively you want to buy more of the stock at 70 because it feels cheaper to you, right? Because that's how we are wired, right? As in when we go to a shopping mall, we see a sale, we see a discount, we want to buy that, right? But in the stock markets, the way to make money is not buying what is cheap. It's really to buy what seems expensive, because things that are expensive tends to become more expensive over time, right? Things which are cheap tends to become cheaper over time, right? Okay. And most people forget. I mean, can't kind of make peace with this different way in which the stock market works, right? Because otherwise, in real life, if Apple was at 50 rupees a kilo, at 80 rupees, at 30 rupees a kilo, it is a screaming buy, right? As in you should probably buy more apples. But in the stock markets, if a stock was at 50 rupees and it came to 30 rupees, maybe it's an avoid, right? Or at best, even if you're buying, you should probably buy as little as possible, right? As in, so stock market is about that, right? It's about risk management and how you manage money, because where does a stock price go to? It's absolutely no control of yours, right? As in it's almost impossible for anyone to predict which stock is going to go up, which stock is going to go down. But when you have a bunch of stocks in your portfolio, I think just understanding the money management is the second most important thing. Probably the first most important thing of investing and trading in the markets.